What do I mean by all that? Well, short run version is recession, of course. More and more data tells us that we're heading into recession, including another, several actually, major layoff announcements from prominent companies, one after another, which tell us exactly what the yield curve had told us to expect all along. And the problem is, when you hear from economists and especially policymakers at the central bank, they come up with all sorts of excuses about why you shouldn't pay attention to particularly the bond market. Oh, the Fed buys bonds, therefore it's poisoned the whole well. Inversion doesn't mean something until it doesn't mean anything until Jay Powell says it means something. There's any number of rationalizations out there about why you should look at a yield curve and just say, no, I'd rather trust Jay Powell and the FOMC. They have complicated, really elegant, sophisticated mathematical regression equations. So why wouldn't I trust them over a bunch of greedy bankers in Wall Street and everywhere else? But as it turns out, yet again, the way in which the economy is unfolding, therefore the risks, not just to the economy down the road, but also to financial markets, have been priced accordingly. And they're available for everyone in real time as everything unfolds.
This is just beyond understanding that everyone is paying the cost of recession, but no one wants to accept that there is actually a recession. One of the great minds said that it's easier to fool people than to make them accept that they have been fooled. The Fed and the policymakers are all on the same page to try to get rid of the recession while everyone is in the heated debate of whether we are in a recession or not. You see, that's the worst knowledge crisis we can be in. However, Jeffrey SNIDER, from Atlas Financial Advisors, has got the insights that declare, once and for all, that recession is already here. And yes, there is a logic behind it if you doubt that. What is Jeffrey SNIDER saying? Well, let's listen to him because he is rising as some of the few market analysts who are telling things as plainly as they can.
Today we got more big layoff announcements. Of course, we've had them pretty steadily since November, and that kind of gets us into this situation where we're asking these types of questions. Companies have been announcing layoffs, but yet it doesn't look like we're in recession. We're hearing about something going on in the labor market. When we look at the labor market data, it says there's absolutely nothing going wrong. So you can understand from a certain situation, a certain perspective where you would say, yeah, the economy looks like it's actually holding up really well because we've got these layoffs, we've got all this uncertainty, consumer price pressures, we're hearing about all these negative things, and yet the labor market data looks relatively good, if not really good, which we could then interpret as the economy is holding its own despite massive headwinds flying into its face. So we have a little bit of a slowdown. Maybe it's not all that much. But yet more and more the data keeps saying, no, it's not. It's going in the wrong direction. And it's not just corporate stories about layoffs, but the corporate layoff announcements, at least the details of them, give us a real good sense about why there's this really divergence between what markets have predicted, what's actually going on, and what we can see in particular with certain data accounts. Again, one reason why economists say to ignore markets, well, I mean, they have a variety of reasons, but the real reason is, as I talked about in yesterday's video with my good friend Stephen Van Meter, markets point out all of the ways in which economists are absolutely wrong. Not just policymakers at the Fed, but the mainstream economic interpretations, beginning with, in this cycle, what happened in 2021 in particular. Most economists, Larry Summers in particular, but he was obviously not alone, said the government stimulated the crap out of the economy and generated legitimate 70s-style inflation. An overheating economy that eventually Jay Powell and his crew were eventually going to have to do something about, because the economy, especially the labor market, labor shortage, all that stuff that you heard over the last couple of years, made it seem like the economy was doing not just well, but too well. And a lot of people, not just in the public, a lot of people in the corporate world, those running businesses, believed that message. And as the CPIs went higher and higher and higher, unable to interpret the information that was in front of them, they said this is confirmation of what the economists were saying. A red hot economy, in Warren Buffett's terms, a red hot economy that was likely to stay red hot, because economists also tell us that when governments do a lot of things, those things tend to build upon each other more and more over time. So if a government does a lot, it's supposed to multiplier greater than one. It's supposed to lead to long run impacts. In this case, an overheating economy that was likely to stay hot for a long period of time.
There is a simple yet genius technique to trace whether you are being lied to or not. Especially when it's a matter related to the economy or politics, you can easily test the reality by carefully analyzing what's being said. If every leader, policymaker, and other stakeholder is giving contradictory statements on the same matter, understand you are being lied to. That's what's happening with the recession. In the US, everyone is honestly musing about whether they are in a recession or not. They want to believe that recession is not only knocking at the door but has entered the house. Yet, they want officials to accept it, which is not going to happen. You should understand one thing here. The worse households are in, the falling economy, and the crumbling financial market are evidence that we are in a recession. However, the government and the Fed have not endorsed it. But why? Well, the market sentiments and the impression that an official recession creates are more shocking than the actual recession. In other words, when everyone knows that the government has accepted recession as a reality, they lose trust, which calls for a market crash. To avoid this, literally, nothing about recession is being said by the Fed and the government. They are acting as if they don't know it exists simply to give the impression that citizens should not be worried. But the reality is a recession is already here. But what's the proof? Well, some of the biggest and top-performing companies are laying off their employees. With the start of 2023, companies joined the bandwagon to fire their employees to save costs because the recession has worsened things. Spotify has laid off its 6% global workers, which amounts to 400 out of 6,600 workers. Google has also announced to fire a staggering 12,000 permanent employees who also make up 6% of its total global workers. But that's not the end. Microsoft will be getting rid of its 10,000 workers while Amazon is firing 18,000, the highest in its history. Coinbase has already laid off 20% of workers in January this year, while Goldman Sachs has gotten rid of 8% of employees. And what do these layoffs tell us? Here's a little reminder to like the video if you are loving it. And if you don't want to miss videos about the evolving economics and the financial order, subscribe to our channel. Let's continue now. Well, the reason behind layoffs is simple. These companies are ruling the markets, and when they lay off, it means they are not earning enough. Investors have heavily invested in these companies, which, in turn, bring lucrative returns. But the scenario has been completely changed now. So precarious is the situation that covering expenses for these companies is becoming difficult. They are not earning and making profits as much as they should to keep their workers employed. Imagine when a business will start giving up its most valuable asset, the employees. Well, this will happen when it has no other option, when the market is hitting it hard, and when the recession has made the business clogged. You see, that's the contradiction which no one can hide. On the one hand, recession possibility and existence have been ruled out while, on the other hand, companies are firing their employees. This just says it all about what we are in. However, you won't find anyone pointing toward that. All the economists, market analysts, and policymakers have been spreading the news that the economy was and is red hot. In other words, they believe the economy is working at its maximum level. Well, they should be made to peep into the real situation and asked to explain about that. But is it enough to prove we are in a recession? Well, we should not trust it that easily, right? So, listen to Jeffrey SNIDER talking about the leading economic indicator ringing the bell about a recession.
Leading economic indicator from the Conference Board. And the Conference Board's leading economic indicator has been a relatively decent leading economic indicator, in particular when it flashes below what it calls the recession threshold. The recession threshold is when its LEI index falls at a greater than 4% annual rate in any 6-month period. Now, in November and December, the index has declined sharply. They just released the December figure, down 1% in just that 1 month. Over the last 6 months of 2022, the leading economic indicator from the Conference Board is down at almost an 8% annual rate, so well within the recession territory. And the director of economics at the Conference Board even indicated, it said, the U.S. LEI fell sharply again in December, continuing to signal recession for the U.S. economy in the near term. There was widespread weakness among leading indicators in December, indicating deteriorating conditions for labor markets, manufacturing, housing construction, and financial markets in the months ahead. So the leading economic indicator says we're heading toward recession, and now it's got to a situation where probability that we don't get into recession is exceptionally small. This would be the first time, at least in the LEI's, the Conference Board's LEI's history, where that wouldn't happen. But it's not just the LEI, is it? It's everything else that we've seen. We've been talking about recession. We've been seeing data move in that particular direction for a long time. So it's the LEI is adding more weight to the evidence that we're probably already in one. I would date a recession back to last June, but I don't get to decide these things. It's very likely that when the NBER finally gets together and interprets the data in the correct way, all the data, it'll probably say November or December was probably the beginning of the recession. But why will the NBER have so much problem, like it did in 2008 or the year 2000 or the year 1990-91? It's because of how we have this information problem. And the Conference Board actually speaks about it in their press release.
This indicator signals whenever the economy goes down and passes the recession threshold. When the leading economic indicator index falls by more than 4%, it surpasses the recession threshold. Simply, when this happens, it means we are in a recession, which has been proven before. The LEI index has been falling sharply by 8% for the last 6 months. Now, in December 2022, the index went below the recession threshold, declaring that we are in a recession. Even the director of economics at Conference Board, Jeffrey SNIDER quoted, also says a looming recession in the U.S. which will worsen the housing market, manufacturing, labor, and financial market as well. We already had evidence about a present recession, but these indicators and actual actions taken by the companies are further reinforcing it. But the Fed is not ready to accept it because we have an information and knowledge problem, as Jeffrey SNIDER said. Information that tells the real facts and reality is hidden or is made impure with lies. This makes the whole atmosphere quite ambiguous, and trusting anyone becomes a problem. Well, the good news is that when this happens, understand something is wrong. In this case, the wrong is this: the recession is already here, but the Fed will try its best to hide that. Now, you should decide where you will invest and what you will do, considering that you are in a recession. Do you think we are not in a recession? Or did you earlier feel you were missing something that could prove the recession was there? Tell us in the comment section right below about how you are preparing to live in such an environment. Do you want to watch more videos like this one? If yes, please like and share the video and subscribe to our channel for more videos on the latest economics and financial news. Until the next video, stay tuned.